Welcome, students. After having talked about the basics of the cost of capital or for calculating the cost of capital or need of the cost of capital, and having known about that how to calculate the cost of the debt capital and how to calculate the cost of the preference capital, now we would learn about that how to calculate the cost of the equity capital, which is a very important source of funding any investment avenue or maybe the investment say option or maybe a new project or a new venture. So cost of equity is typical thing, and calculation of the cost of equity is not very simple, because you cannot say that the dividend paid by the firms to the equity shareholders is the cost of equity, because number one, dividend is not the right of the shareholders, and second thing, it is also not fixed for every year, and it's not sustainable also for all kind of the firms all the times, because of their cash flow positions or maybe their profitability positions. So when it is not fixed, if it's not regular, then it cannot be called as a cost of equity. So dividend in any case cannot be called as a cost of equity. So for calculating the cost of the equity, we will have to have a different method, and we have to calculate the cost of equity by using the most appropriate method, or the most appropriate process, which is most logical and most usable. So when you talk about the equity capital, first of all, you try to understand what we call it as the equity capital. Equity capital is something which is the investment which is provided by the equity shareholders or the real owners or promoters of the business to the project, right, or to the venture. That is the equity capital. And when a firm becomes a public limited company, because you can have the different kind of the business organizations, you can have a sole proprietorship. Initially you can start at a very small level. Then if you start growing, if the product is sellable in the market, then you grow over a period of time. So you can ask other people to join with you, so it can be converted from the sole proprietorship to a partnership firm. And when it further grows, then the partnership firm can be converted into the private limited company, if it is a private limited company or privately held company. So in that case also, the equity capital, real equity capital, cannot be called as equity capital, but yes, the investment coming from the promoters or the owners of the company would be the equity capital. But the real definition of the equity capital is understandable in case of the public limited companies. So in the simpler terms or simple words, you can understand that any investment provided by the owners of the business, the promoters of the business to the business, is the equity capital. And for that, maybe in that sense, if you talk about in the sole proprietorship firm also, when the capital is provided by the sole owner of the business, that is the equity. And if it is a partnership firm and their contribution, respective contribution, is provided by the different partners, that is also a kind of equity, their contribution. And in the private limited company also, because it's not a public limited company, so capital is coming from either the owners of the business or maybe by borrowing from the market. So that investment of the owners of the business is basically the equity capital. But the real equity, if you talk about, is that is in the public limited companies, and that can be in two forms. Number one is the first say investment given by the promoters plus the funds raised by selling the company's shares or stocks in the open market through IPO, right. That's the one part of the story. And when that capital comes to the firm and it is effectively utilized, and firm earns good profits or business earns good profits, so part of the profit is distributed as a dividend and part of the profit is retained back. So that retained earnings or retention of the earnings also becomes the equity capital. And if, for example, you have fully exhausted the capital raised through IPO, and if the retained earnings are also not sufficient, then you can go for the FPO also, followed on public offer. You can raise the further capital from the market by selling the further equity in the market, right. So for the sake of definition of equity, if it is a sole proprietorship, so the investment of the owner is the equity. If it is a partnership firm, it is also, again, you can say the investment made by the partner is also equity, because the owner's investment. And if it is a private limited company, so the promoters or maybe the owners, the capital which is provided by the owners of the company, that is also a equity capital, for the sake of maybe understanding. And real definition of the equity capital is in the form of the public limited companies, and the public limited companies raise the equity capital through IPOs when they are converted from the private limited companies to the public limited company. For example, a few years back when Zomato was converted from the private limited company to a public limited company, so they came out with an IPO. Paytm was converted from a private limited company to a public limited company, so they also came out with an IPO. So every day many companies who have reached up to that level and they fulfill the criteria of going public, so they can be converted into public limited companies from private limited companies, and any capital which is raised through issuing the IPOs, that is called as the equity capital, plus the capital given by the promoters of the company, that is also called as the equity capital. So when we use the funds raised through equity capital, maybe in any kind of the businesses, plus the capital through borrowed funds, when the total internal and external funds invested in the business or into the projects, and when we say convert that into the profit making venture, so profit earned is divided into two parts. One part goes to the owners for their maybe livelihood expenses, and other part is retained back in the business and that is reinvested back into the business. So that is called as a retained earnings. So the retained earnings is also is at par with the equity capital, and equity capital itself maybe which is given by the promoters or raised by IPO or by FPO, that is also the equity capital. So both are treated at par. So sources of the equity are depending upon the type of the business, any kind of investment which is given by the owners of the business to the business, or any investment which is made by the owner of the business in the business, that is called as equity capital. But real definition of the equity capital can be understood in the reference of public limited companies, and in case of public limited companies only, there comes a challenge of calculating the cost of equity, and there we have to use the different models for calculating the cost of equity. So cost of equity, for calculating the cost of equity, we have two sources: retained earnings, and then is the further equity capital be issue in the market. So investment made by the promoters, capital raised through IPO, and retained earnings, that is the first part. And for example, that is fully exhausted and company doesn't want to raise the further funds through debt but through equity, so they can go for FPO also. So any additional equity which is issued in the market, that is also becoming the, or that will also become the equity capital. So in case of the public limited companies especially, calculating the cost of equity is a challenge. So finally, we can understand that irrespective of whether a firm raises equity finance by retaining its earnings or issuing the additional equity, the cost of equity is the same, right? Whether it's coming from the part of the profit or as an investment of the promoters or through IPO or through FPO. If it is equity capital, cost of all kind of equities, both retained earnings and the owner's investment or shareholders' investments is the same, and the only difference can be in terms of the flotation cost, right? Because you pay the flotation cost for raising the equity through IPO and FPO, but you don't pay any flotation cost when you add up the retained earnings into the equity capital of the business. So no flotation cost is paid. So only maybe in that respect, the retained earnings and the other equity is different. But for calculating the cost of capital, all the equity capitals, whether given by the promoters, by shareholders, or by maybe the additional shareholders or retained earnings, that is also same, and we apply the same cost of capital to all the sources of the equity capital. Only flotation cost is different. We will discuss the flotation cost in the subsequent discussion. So barring flotation cost, the rest of the cost of equity is same, irrespective of the source of equity, whether it is the retained earnings or whether it is a investment made by the promoters or by the shareholders. Now, for calculating the cost of equity, we have different approaches available here, different methods available here. First one is the capital asset pricing say model approach, CAPM approach, which is a capital asset pricing model approach. Then second approach is the dividend yield plus risk premium approach. Then we have the next one is a dividend discount model approach, and last one is the earnings price approach, right? Earnings to price approach means, you can say practically, you can say it's a earnings to price approach. So four ways are there, four methods are there for calculating the cost of the equity, or you call them methods, you call them ways, you call them approaches. They are the four ways to calculate the cost of the equity. And maybe All the four methods are being used by the firms practically in the market for calculating the cost of the equity, but the most widely used method for calculating the cost of the equity is the capital asset pricing model approach. Right, this is the most commonly used method, or this is the most commonly used approach in the market, which is called as the capital asset pricing model. Now let's understand all these four approaches one by one quickly. First one is the CAPM approach. People call it as a CAPM also, but we should not call it as CAPM. The real name is the CAPM, capital asset pricing model, right? So we will have to use this, and for calculating this, right? For calculating this, it is written here, say for example, that it is useful to decompose the total risk associated with a security into two components. So it means, because as we say, the total cost is the result of risk. Cost is basically the rate of return, and the rate of return is basically the reward of the risk. So higher the risk you are taking by making any investment in the any risky avenue, or maybe into the any risky business, more return you can expect out of that. So risk and return go hand in hand. So maybe you call it as the cost, you call it as the risk, or you call it as the return. So cost and risk, or the return and risk, they are going hand in hand. They will go hand in hand. So we will have to understand here that while we make investment into any stock, into any say equity share in the market, maybe through IPO, or maybe through the secondary investment, through the resale in the market, through stock exchange. So we will have to first of all evaluate the risk involved in that particular security, and as per the risk involved in that particular security or making investment in that security, the cost of that say capital would be decided, because as per the risk the return would be decided. So how much is the total risk involved? Accordingly, the total return would be worked out, and that return would be in a way called as the cost of equity. So when you talk about the total risk associated with the security or with the stock of any company, is that is having two components. One is the unique risk, and second one is called as the market risk, right? Market risk is basically, you call it as the systematic risk, which is coming out of the overall financial market systems, and unique risk is the security specific risk, that particular stock specific risk. Stock specific risk means because of the product profile of the company, whose stock it is, overall past performance of the company, historical performance of the company, of whose product it is, and any kind of the other sources of the risk of that particular security because of the operating or the financial structure of that particular company, whose stocks are here and we are planning to invest into that stock. So one is a unsystematic risk, you call it as a unique risk or a security specific risk. Other one is a systematic risk, you call them as a market risk or the index based risk. So in this case, as we can understand it, that since the unique risk of the security can be diversified, right? So this risk you can talk about is that if you want to invest into a security which is a riskier investment, so you can diversify your total investment into different kind of securities. Some of the investment you can make into the riskier securities expecting higher return. Some of the investment you can make into less riskier securities, maybe expecting lower return, but that high risk coming from the high return securities would be compensated or mitigated to some extent by making investment into the securities which are giving though low return, but the risk level is also low. So for example, the risk level in one security goes up and other security goes down. So almost you are here and your risk is managed. So by diversification in the portfolio, you are not supposed to put all your eggs into one basket. You should diversify your total investment. So when you are diversifying your total investment, it means high risky securities can be compensated with the low risk securities. So maybe the rate of return on the high risk securities would be high, on the low risk securities would be low, but finally we would be able to achieve that rate of return which is our expected rate of return from any investment we want to make, or that may be called as the required rate of return also. So for earning the required rate of return, you can make a very balanced portfolio having the riskier or the less risky securities, and that way, by way of diversification, right, by way of diversification, you can manage the risk of the a particular security or a specific security. But that diversification doesn't help in managing the market risk or systemic risk, right? Or the systemic risk. So, maybe it's clearly given here that since the unique risk of a security can be diversified away, whereas the market or systematic risk cannot be diversified away, and CAPM suggests that the investors are compensated for taking the systematic risk. It means, as per the capital asset pricing model, when you are not able to manage the systematic risk, when you are not able to manage the market risk, for that purpose you need to be compensated for that. So it means the total cost of that investment. Maybe if you make investment into a risk-free security, that much of the return you deserve by making investment into a stock, but you deserve additional return also for taking the additional risk, which is called as the market risk. Because if you give your investment to the bank, so you're not taking any kind of the risk, so that's basically called as the risk free rate of return. So it means risk is zero, so almost the return would also be negligible or a very low. And if you compare the bank return or the bank interest against the inflation, so sometime it is comparable, almost equal, or sometime the bank returns are less than the rate of inflation. So in overall the value of your money goes down. So you're not interested into making the investment into the bank, you want to take some risk. So when you want to go for some risky investment or choose the investment avenues which are little riskier, and for example you go to the stock market for the higher returns, for seeking higher returns, so you deserve to be given the rate of return which is a risk free rate of return, plus you should be compensated for the risk which you are taking by going to the market or investing your funds in the market. So your total return on that particular investment, total return on that particular investment in that equity or into that stock would be the sum total of the risk-free rate plus the market risk premium. Risk-free rate plus the market risk premium, that would be your total return expected from that investment into that security, and that is basically the crux of the CAPM, which helps us to understand the total say cost of our equity or investment in the equity, which comprises of the two parts, risk-free return as well as the compensation for the risk we are taking, which we are which we are taking while going to the market. And because of the systematic or the market risk, we are putting our investment into the risk, so the return has to go hand in hand. So you need to be compensated for the market or systematic risk also. So total cost would be risk-free rate of return plus the premium for taking the market risk, and this is basically the capital asset pricing model. So if you see the capital asset pricing model here, so in the following equation, for example, when we talk about this equation, the following equation, you can understand that how the this CAPM works. What is the expected return from investment in the security or in any particular stock of a company? So for calculating the cost of the equity, and this model is especially applicable for calculating the cost of capital for the public companies or the public limited companies. It's not workable, it's not applicable in the private limited companies because of certain reasons. So in the public limited companies, for example, you set up a venture, and that is initially is set up in the form of a public limited company. So there the cost of equity calculation would be possible with the help of CAPM. But if it is not a public limited company, if it is a privately held company, or if it is a partnership firm, or if it is a sole proprietorship, in that case you have to use the other modes of calculating the cost of the capital or the rate of return on your equity as the owner of that investment. CAPM is useful only in case of the public limited companies. If the people invest into the stocks of the companies which are publicly held, and the project is set up in the form of a public limited company, then CAPM is used for calculating the cost of equity. So in that case, for calculating the cost of equity or expected return from the security, means any particular stock, we call it as the security I here, or that particular stock of a company which is named as I here. So as I told you, it has to be sum total of the two things, risk-free rate of return plus the expected compensation for the market risk we are taking. So in this case, you are taking here that it's the formula says RF plus CAPM model is RF plus expected market return minus risk-free rate of return. Right, expected market return, or the expected return on the market portfolio minus risk-free rate of return and multiplied by something which is called as beta. Right, beta signifies the systemic risk of a security. Beta signifies the systemic risk which is affecting the return of that security. So it is RF plus ERM minus RF multiplied by beta. So ERM is the expected return on the security I, or a security or a stock of a company. RF is the risk-free rate of return. ERM is the expected return on the market as a whole, market portfolio or the market as a whole. And beta is basically the systemic risk of that security, that because of the stock market or financial market risk, which is going to impact the return of that security and subsequently the cost of that security. So beta is the signifying that risk. So if you want to calculate the cost of equity, you should have the risk-free rate of return also. You can take the treasury bills or maybe the government securities, which are basically gilt-edged securities, where you when you make investment into any security, maybe a short term or a long term, issued by the government, so you don't take any kind of risk because they are the gilt-edged securities. And when we make investment into any government bonds or government securities, we can expect that government is not going to default, and whatever the promised return in the form of interest as well as the maturity value is there, that would certainly come back to you. So it becomes the risk-free rate of return. You can take the short term 3 months or maybe the 10 years long term bonds. Then you have to take the expected market returns from the say existing sources and subtract from this the risk-free rate of return and multiply it by the beta. So this model is basically called as a CAPM. This model is basically CAPM, capital asset pricing model, and this model says that when a person makes the investment into a public limited company or a stock of a public limited company, he should be compensated for the risk he is taking along with the risk-free rate of return, which he is otherwise expected to earn if he makes his investment into a security which is not a public limited company's security. So in this case, the inputs required for the CAPM are: number one, risk-free rate of return, right? So risk-free rate of return can be rate on the short-term government securities, treasury bills, because they are gilt-edged and government is not expected to default. Rate of return on a long-term government security that has a maturity value of 10 years. So either you can take the short-term government securities or you can take the long-term government securities. Companies use both for calculating the cost of their equity. For calculating the market risk premium, so you can take the historical risk premium which is available in the market, or you can expect that how the market is going to behave in the future. So what would be the forward looking risk premium, so you can take those values also. And for calculating beta, you can use this model or this particular equation. This model is going to help us to have that beta or the systematic risk which is coming out of that investment to be made in that security. And finally, for calculation of the beta, while using this particular equation, you can say here that finally it works out in this form, and the numerator says that numerator is basically the covariance of the return on the individual security and the market return. It's a covariance of the two things, return on the individual security and the market return divided by the variance of the market return, right? Divided by the variance of the market return. So you have to take first the covariance of the individual, covariance of the return on the individual security and the market return. So this data is easily available from the say existing published sources, and divide the this covariance by the variance of the market return, and finally you will get the value of the beta. So this beta is used for applying or for calculating the cost of equity if you want to calculate the cost of equity by using the capital asset pricing model. So in this process, the model says that you have to have the risk-free rate of return, which can be any government security, maybe a long-term or short-term. Expected market return can be historical data, which is how much return the index, market means index, the index has given, that is available from the stock markets or different sources. And or you can predict for the future also, that in future that how much is going to be the index return or the market return. And risk-free rate of return is again the same thing. And for calculating the beta, you can use this particular equation, and if you convert this equation, so you can say this simply, it says that beta is basically the covariance of the return on individual security and market return to be divided by the variance of the market return. So that will give you the beta value. If you put all these values into the CAPM, you would easily be able to calculate the cost of the equity. But as I told you earlier also, that this is useful only for calculating the cost of the companies which are publicly held or which are the public limited companies for whom the beta information is available, beta value is available. Because for a privately held company, market return will not be there. So you cannot calculate the covariance of the return on the individual security and the market return, because privately held companies' securities are not traded in the market. So if they are not traded in the market, so market return is not there. So you cannot calculate the covariance of the return on the individual security and market return, and you cannot have the denominator also, that is the variance of the market return. So you cannot calculate beta. So you cannot use this model for a privately held company or maybe a partnership firm or a sole proprietorship. For that purpose, you have to use some other methods, maybe the rate of interest or maybe commonly available cost of capital in the market or the rate of return which you expect by investing your capital into that kind of the project or into your project in that form. You can make it as a sole proprietor, you can set up your small business, or you can, in the form of a partnership firm, you can set up your own venture, startup or a project, or in the form of a private limited company, you can set up your business or venture. And initially, before they grow up to a level, all the projects or ventures by the new entrepreneurs or group of new entrepreneurs are set up either in the form of sole proprietorship or a partnership firm or a private limited company. Once they successfully grow up to a level where now they can be converted into a public limited company, then they are converted into a public limited company. For example, you talk about Zomato. Zomato was in the market for past so many years. Recently, it is converted into a public limited company. Paytm also is in the market for past so many years, but recently is converted into a public limited company. So first you have to prove your mettle as a private limited company or as a partnership firm or as a sole proprietorship. Right. For example, Karsan Bhai's Nirma was as a sole proprietor also he did the business. As a private limited company, he did the business, and at very later stage, he converted that into a public limited company. So you have to convert finally your business, because every business, maybe it's started as a sole proprietorship. If you talk about the Jeff Bezos, the owner of the Amazon, or maybe the promoter of the Amazon, he started his business from a garage, right? A very small level business as a sole proprietor. So every business which is set up as a sole proprietorship, the owner has as a dream that one day I will make it as a transnational company or a multinational company or a transnational company. But beginning is always as a sole proprietorship. So you can start as an individual organization as a sole proprietor. So you can invest your own resources, your financial resources, or maximum you can borrow from your family and friends. So that's a sole proprietorship. If it becomes successful and it grows, you need more capital, so you can bring more like-minded people, so you can convert that into a partnership firm. Then if it further grows and you need more resources, you can convert that partnership firm into a private limited company. And once it's successfully proven its mettle, then you can convert that into a public limited company. When it's a public limited company, you can use CAPM for calculating the cost of equity. Until that, you have to use the other ways of calculating the cost of equity. But anyway, if it's a public limited company, and if the beta value is available, so the cost of publicly held companies, the cost of equity of those companies can be calculated by using number one, first approach by CAPM. And after that, we will have to talk about the other methods also, that is the bond yield plus risk premium approach and subsequent other approaches. So as I told you in the beginning, we have the four approaches with the help of which we can calculate the cost of capital. So first we talked is about, that's the CAPM, a most used technique in the market, largely used technique in the market, or the approach used in the market for calculating the cost of equity for publicly held companies, that is a CAPM. But we will discuss quickly the other approaches also, but that in the next class. So for the moment, we will stop here, where if we recall, we talked about the approaches of calculating the cost of equity, means the third important source of capital for the ventures, for the projects, that's the equity capital. And for calculating the cost of the equity, though we named four approaches, but we discussed and learnt about the first approach, that is CAPM, in detail. In the next class, we will discuss in detail the other three approaches, and then we will move forward with the further discussion on the further discussion for calculating the cost of capital. Till then, thank you very much.